When most people hear Roth IRA, their eyes light up. Tax-free growth, no RMDs required minimum distributions. Sounds like a no-brainer, right? But here's the thing. Sometimes converting a Roth IRA can actually cost you more than it saves. And in fact, in some situations, you could end up paying unnecessary taxes, missing out on even better strategies, or hurting your retirement plan. So in today's video, I'm going to walk you through 10 scenarios where a Roth conversion might just not make sense and why skipping it may save you a costly mistake. Hi, everyone. I'm Jim Martin. I'm the founder of Martin Wealth Solutions and a financial planner. And I want you to know right up front, Roth conversions, they are powerful tools, but they're not for everyone. Reason number one, no cash to pay for the taxes. This is the first big mistake I see when people don't think about how they're going to pay their tax bill. Remember, converting to a Roth doesn't mean the money magically avoids taxes. It just means you're choosing to pay them now instead of later. And if you don't have cash outside of your IRA, that can be a real issue. So you need that cash to cover the tax bill because the math can break down very quickly. Let me give you an example. Let's say you convert $50,000. If you pay the taxes from cash savings, maybe that's $13,500 up front. Painful, sure. But after about 5 years, the Roth could begin to pull ahead if the math works. Now let's change the scenario. If you don't have cash on hand, you pay the taxes out of your IRA, and suddenly that conversion never gets ahead. Even after 20 years, returns dependent, you may still be behind compared to not converting at all. So here's the bottom line. If you don't have cash to pay the tax, it may not be the right time to convert. Reason number two, you already have a really large brokerage account. A second reason a Roth conversion might not make sense is you already have significant money outside of your IRAs in a taxable brokerage account. Why does that even matter? Because brokerage accounts already offer some pretty attractive tax advantages. For one, when you take the money out of a brokerage account, you're often taxed at a lower long-term capital gains rate, maybe 0, 15 or 20%. Compare that to 22, 32, even 37% for IRA withdrawals. Well, that's a big difference. Number two, brokerage accounts get a step up in cost basis when you pass away. That means your heirs, they might not ever have to pay taxes on that money they inherit in a brokerage account when they inherit it at the market value at the time of your death, often avoiding capital gains and estate taxes altogether. So if you've already built up a big brokerage account, you may already have a tax-efficient source of dollars to create income in retirement and to pass on money to heirs. Paying a big upfront tax bill for a Roth conversion, well, it might not make sense if you have a big brokerage account. Let's move to reason number three. What if the tax system changes? Look, every few years, there's political chatter about scrapping the income tax season, about a flat tax, about a fair tax. Others even talk about a national sales tax. Even President Trump has floated ideas like tariffs replacing part of the tax code. So let's be clear. The U.S. income tax system has been around for a long time, and we do have incredibly large national deficits. It's not likely to disappear overnight, but if it ever did, paying taxes up front on a Roth conversion, well, you might really regret that. It could feel like a total waste. So while you shouldn't let your political speculation drive your entire strategy, you should at least acknowledge the risk. Roth conversions are a bet that income taxes will continue to exist and in some cases go higher over time. Reason number four, you're planning charitable giving. One of the biggest drivers for Roth conversions is avoiding required minimum distributions, or RMDs, or some people even call them MRDs. Once you hit age 73 or 75, depending upon your birth year, the IRS forces you to withdraw money from your traditional IRA, your 401k, your 403b, assuming you're not working, and those withdrawals are taxable. But what if you're already giving money to charity? This is where QCDs, or qualified charitable distributions, they come in. Once you're 70 and a half, you can give up to $100,000 per per year directly from your IRA to a qualified charity. That counts to your RMDs, and you don't have to pay taxes on it. So if charitable giving is part of your plan, you may not need to do a Roth conversion. And if you plan to leave your IRA to a charity after you pass, then a Roth conversion, well, it might not even make sense. Why? Because charities don't typically pay taxes on IRA money. Converting in that case means you've paid taxes unnecessarily. So reason number 5, not enough time to reap the benefits. Look, Roth conversions, they work best when you have time, lots of time, for tax-free compounding to help offset that upfront tax bill. But what if you don't have time? Look, we're all getting older. Maybe you're older, maybe your health isn't great, or maybe you simply plan to spend down your accounts in retirement. Does that really make sense then to do a Roth conversion? Look, in many of these cases, the math, well, it just doesn't work. It's important for you to run the numbers before you consider doing a Roth conversion. If your time horizon is shorter or your heirs are in a lower tax bracket, a Roth IRA, it might just not make sense. So it is really important for you to understand how it works in the context of your overall plan. We're going to move on to number 6 here, the hidden costs, Medicare and ACA subsidies, if they're even there next year. Here's one people, well, they often overlook, the hidden cost. Look, a big Roth conversion can raise your modified adjusted gross income. And that's really important because it can trigger higher Medicare premiums through something called IRMA, income related monthly adjustment amounts. I know that's a mouthful, so we'll just say IRMA. It can also disqualify you from Affordable Care Act subsidies if you're not yet on Medicare. Translation, you might pay thousands of dollars more in healthcare costs simply because of the conversion. So when you run the numbers, don't just look at the marginal tax rate. Factor in Medicare and healthcare subsidies as well before making a decision if a Roth conversion makes sense for you. Let's move to number 7, expecting lower tax rates in the future. Look, I'm with you. I think taxes will likely go up. Roth conversions, however, are most effective if you expect your tax rate to stay the same or go higher in the future. But what if you expect your income to drop? What if you're planning to move to a lower tax state? For example, I'm based in Virginia, but I see many retirees move to Florida, Texas, South Carolina, Tennessee, states with no income tax. Well, South Carolina does. But if you're paying state taxes now, but plan to relocate later, it might not make sense to do a Roth conversion while you're still in a higher tax rate state. In short, don't prepay state taxes if you know you're leaving and you're going to relocate. Reason number 8, the pain of a big tax bill. Look, sometimes the math says a Roth conversion, it makes a lot of sense. But let's be real. Writing a giant check to the IRS, it hurts. It hurts me even thinking about it. And if you can't stomach that upfront pain, what's an alternative? One approach is to take a pro rata withdrawal strategy, pulling both from your brokerage account and your IRA accounts early in retirement to fill those lower tax buckets, because that might help smooth out your taxes without the shock of that big, giant tax bill. The best strategy isn't always about maximizing every last dollar mathematically. Sometimes it's about what you can actually live with. And maybe it makes sense rather than doing that big, lumpy Roth conversion, just to do an amount up to the tax bracket you're in. There are many different strategies out there, and it's important for you to run the numbers on all of them so you can make the right determination. Number 9, you're still working and in a high tax bracket. I get a lot of questions about Roth conversions while people are still working. And if you're still working and you're a high income earner, a Roth conversion mathematically doesn't make a lot of sense most of the time. Why? Because you're likely in one of the highest tax brackets of your life. And once you retire, your income will often drop. Not always, but many times, at least in those first few years before Social Security and RMDs kick in. So that's usually the sweet spot for conversions. So if you're in a high tax bracket today, focus on smart contributions instead. Max out your pre-tax 401k. Maybe add some Roth contributions if the plan allows. I like balance. I think it's okay for you to have both. And if you've got extra cash flows, explore strategies like mega backdoor Roth IRAs or even backdoor Roth IRAs. Then when you hit retirement and your income drops, you can revisit Roth conversions to see if they still make sense. Reason number 10, converting too much too fast. Even if a Roth conversion makes sense for you, and it makes sense for a lot of our clients, then the way you execute it, it really matters. I've seen people try to convert their entire IRA balance in one shot. And while the idea of getting it over with, pulling that Band-Aid off, it's tempting, the tax bill can be massive. By converting too much in a single year, you may push yourself into the highest federal tax bracket, 32, 35, even 37%. And let's not forget about your state taxes. And it can trigger all kinds of knock-on effects like higher Medicare premiums and loss of deductions or credits. A better approach, phase conversions. Convert smaller amounts over several years, often filling up those lower tax brackets like 12 or 22 or maybe even 24 instead of jumping straight into the 32% territory. That way, you still move money into Roth accounts for long-term tax-free growth, but you avoid unnecessary pain from paying taxes at the highest possible rates. Sometimes it's not whether you convert, but how much and when. So there you have it, 10 situations where a Roth conversion just might not make sense. I'm going to go into each one again and recap those so you can write this down or add it to your list. And if you find one that symbolizes you, really take note and explore it. And remember, if you like our channel, do me a quick favor, like and subscribe. It really helps other people learn about us. Number one, you don't have the cash to pay for taxes. You've got to withdraw it from your IRA. Number two, you already have a large brokerage account. Number three, the tax system can and likely will change in your lifetime. Number four, you're planning on charitable giving, and that's really important to you. Number five, you don't have enough time for the Roth to compound. Number six, the hidden costs like Medicare premiums or ACA subsidies are a little worrisome. Number seven, you expect a lower tax rate in the future. Number eight, you can't stomach that large tax bill. Number nine, you're still working and you're in a high tax bracket and maybe you'll convert later. And number 10, you're going to convert too much too fast and you need to pump the brakes a little and do it with a little more intention. Remember, Roth conversions, I'm a big fan. They can be powerful, incredibly powerful, but it's not a one-size-fits-all approach. The right choice depends on your tax situation, your retirement income plan, your legacy goals, and quite frankly, and I think this is one of the most overlooked items, your peace of mind. If you'd like help running your numbers to see if a Roth conversion makes sense for you, you can visit my website, martinwealth.com, learn a little bit more about who we are and what we do. Hey, I'm Jim Martin. Thanks for watching, and I'll see you next time.